everyone, and thank you for watching my videos. In the Forex market, many investors are always looking at the charts and comparing price and momentum because there is a relationship, not all the time, but most of the times, there seems to be some sort of coordination between the price and momentum. And by studying the two, this gives them a really strong advantage when we're getting involved in this market. And after this video, you too will have the same advantage. Now, so far in the previous videos, we talked about technical analysis. We even learned about how the technical indicators in our trading platforms, if used properly, can give us a really strong advantage in this market. And we also learned how to read charts carefully. We looked for patterns, and we even looked for the certain positions in the candlesticks to see whether or not the trend will continue or the trend will reverse. So in this video, we're going to take all of that knowledge, put it together, and then use that to learn how to determine the way we read price and momentum. And this will give us an even stronger advantage when we invest in the Forex market. So let's talk about divergence trading and how it works. So divergence trading, it works in low risk trading, which is good because we don't want to risk a large amount of capital right off the bat. And we even look for a good place to exit before the market reverses. So again, we're trying to determine whether or not trends will continue or trends will reverse. And we want to be ready whenever each one happens, because we don't always know, but we can use the knowledge that we have about this market to make a solid, educated guess. Also, this will help us to find a perfect place to enter, and we can determine the relationship between price and momentum by using any of the oscillators that are provided to us on the trading platform. Now, price and momentum, they move together, not always in the same direction, mostly in different directions, but there is some sort of symmetry in the way they move. For example, when prices are making higher highs or lower lows, the oscillators will reflect this. So again, as the prices get higher, higher, and higher, or lower and lower and lower, the oscillators will give us signals of their own to reflect whether or not the bullish trend in which the prices are going higher, higher, and higher, whether or not that trend is strong or weak. So we want to pay attention to that as well. Also, divergence trading is an excellent tool to apply because it lets us know that something strange is happening. So again, we're trying to prepare ourselves for fake outs and false readings because that does happen frequently. Okay, so there are two types of divergence, regular and hidden. And now we're going to examine the differences between the two. So here's an example of regular divergence. It just means that there is a possibility that the trend will reverse in the future. Now, if the prices are making lower lows, but the oscillator is making higher lows, it is considered to be a regular bullish divergence. And again, this usually occurs in a downtrend. So let's take a look to see what this actually looks like. Okay, so here we have a line chart. And notice that the price chart above, the lows are going lower and lower and lower. However, we look at the oscillator on the bottom, it's getting higher. Well, it's not getting higher, but the valleys are getting higher. So again, the valley, okay, on the price chart, the valleys are getting lower, but on the oscillators, the valleys are going higher. Many investors will look at this pattern and they will go long. Now, I'm not saying you must go long. I'm just telling you what millions of investors are thinking when they see this pattern. This looks like a pattern that will begin a bullish trend. Now, here we have another line chart. The highs are getting higher. They're getting higher and higher. However, down on the oscillator chart, the peaks are getting lower and lower. That's also a signal that the bullish trend is getting weaker and weaker. So when we see the prices going higher and higher and higher, the bulls are in control, but how strong is that control? The oscillators will tell us how strong the control is, and depending on how weak the control is, that will tell us that the market is going to reverse its trend soon. So here's what we need to know about regular divergence. It could be found in an uptrend. And as we see from the previous images, the regular divergence is best used when we're picking tops and bottoms. So if we're going to trade on divergences, we should focus on the tops or the bottoms, depending on which trend we're looking at. And the oscillator signal, what this will do is they will give us the momentum, or they will tell us the momentum. And if the momentum is heading in the opposite direction as the price, investors will assume that is a signal for a reversal. Okay, so now let's talk about hidden divergences. It's similar, but there is a small difference. So on the price chart above, the valleys are getting higher. So as indicated here with HL, higher lows. However, on the oscillator chart on the bottom, the lows are getting lower. So price is heading in one direction, the oscillator is heading in the opposite direction. Many investors will consider that to be a bullish signal. As we can see, the trend goes upward. Okay, and then also, this is the truth in when the market is going the other way. So here on the price chart, we can see that the chart is making lower highs. Okay, so the peaks are getting lower and lower and lower on the price chart, and on the oscillator chart, the peaks are getting higher and higher and higher. So again, price and momentum are going in opposite directions, and it looks like the trend will continue. So here's what we've learned so far about hidden divergences. If you're a trend follower, then you should dedicate some time to spot some hidden divergences. Because in a hidden divergence, if you happen to spot it, it can help you jump in the trend easily. And also, we want to keep in mind that regular divergences are possible signals for trend reversals. So regular divergence, the trend will reverse. Hidden divergence, the trend may continue. So that's what investors are thinking when they trade on divergences. So remember that. Okay, so in this part of the video, we're going to learn how to trade divergences. Okay, so now we have a real candlestick chart. And here we can see our downtrend, and again, the highs are getting lower. Oh, here, lower lows. But let's look at the oscillator portion. The lows are getting higher and higher and higher. So again, here we have a bearish trend. However, on the oscillator chart on the bottom, the momentum is going in the opposite direction as the trend. So many investors would assume that this is a bullish signal. So what happens when we go long on this pair? And success. Because again, price is going in the bearish direction, but the momentum is going in the opposite direction. And this gives us a bullish signal. Many investors will go long, and they are enjoying their profits right about now. Okay, so again, and remember, let's go back to candlestick chart patterns. And remember, we got to examine all the knowledge that we have from these videos, because we can see that we have tweezers on the bottom. Now remember, what do we do when we see tweezers on the bottom of a bearish trend? That's also a signal for trend reversal. So the divergences, they're not the only, that's not the only thing giving us the signal for reversal. Candlestick chart patterns, such as the tweezer bottoms. So remember, take all the knowledge that you've gotten from watching these videos, because this will help us get a really strong advantage when we're entering this market. Okay, so another chart. So here we have the downtrend. Now here we have a second line. This line is connecting the lower highs, and this long line is showing the downtrend. So that's why we have the two lines, because I want to emphasize that the highs are getting lower. And then down here, the highs are getting higher. So what do? Will the downtrend continue? And it does, and we're successful. So again, here is an example of how we use hidden divergences. The highs are getting lower, and it's going in the opposite direction as the oscillator, and the trend continues. So we've learned how to trade a regular divergence and how to trade a hidden divergence. Okay, so let's talk about trading on momentums. Okay, so here we have a chart. The highs are getting lower, and the highs are getting higher. Now, notice something. This oscillator is telling us that the market is overbought, and we have a crossover. Now, we've learned about crossovers, and we've learned about what to do when the market is overbought. So, many investors will consider this to be a signal to go short. Oh, and don't forget, we have a line of resistance, and that line has been breached by a bearish candle. And look at where the market is going. Down, down, down. So again, this market is overbought, and there was a crossover, and there was a breach on the line of resistance by a bearish candle. So those were some strong signals telling us the market was going to reverse. So, and that's another example of using the knowledge that we talked about in the previous videos with the knowledge in this video to give us a really strong advantage in this market. Okay, so trading on overbought and oversold. It works like this. So here's a trick that we want to remember. So another trick that would be to wait for the momentum highs and lows to hit overbought or oversold conditions, and to wait for the indicator to move out of those conditions. So when we use these oscillators, we can just sit and wait to see if the market is overbought or oversold, if you have the kind of patience. Some people do, some people don't. Again, each individual investor is different, so whatever works for you, works for you. And also the reason for doing this is similar to that of waiting for a crossover. So again, we can wait for the moving averages to cross over, or we can wait for the market to be overbought or oversold. Now, here is what it looks like to trade on overbought or oversold. So again, here we have some lines of support. Here we have our peaks, and the peaks are getting lower and lower and lower. And notice that at the end of this oscillator, the market, or the oscillator, is showing momentum going higher and higher. So if you had bought just because it wasn't oversold or starting to cross over, and well, we would have gotten burned. So the reason why I'm showing you this is that it doesn't work 100% of the time. So again, we have to analyze and look at the markets in many different ways because we can get the wrong readings sometimes. Okay, so again, lower highs indicating a new downtrend. So here's what we've learned so far. You may think that it is time to buy because the indicator is showing oversold conditions and divergence has formed. But however, we don't know everything about the market, so it's pretty much safe to say that none of these indicators or none of these tools can give us 100% results all the time. So we want to be careful. And also, if you're new to this market, you're not that familiar with the tools, it's going to take some time to understand and study these tools so they become second nature to you. So again, that's why I stress using the demo counts, because by using the demo counts, we can make all of our mistakes early and we don't risk any money. Okay, so we're going to learn how to draw trend lines on the momentum indicators. Okay, so here we have a falling trend line and we've drawn it on the candlestick chart. Now, we're going to draw the trend line on the indicator. So, just like on this downtrend, we've connected the highs. We're also going to connect the highs on this indicator as well. Now, look what happens when we have a crossover here and a breach on the trend line up here. Notice how the market is heading upward after that line of resistance has been broken. Right around the same time, we had a crossover near the oversold condition. Okay, so 9 rules for trading divergences. So if we're going to use this strategy, here is what we need to do and what not to do when we use the divergence method. Okay, so number 1, watch carefully, because it's very easy to make mistakes when we trade on divergences and we don't know exactly what we're doing. So take some time to practice studying price and momentum so we have a strong idea as to how to use this strategy when we make our investments. So this is the right way to do it, okay? So here we see that the highs are getting higher, and here the market is oversold, so that could tell us that we should short this pair. However, it would not be a good idea to use divergences when the market is ranging like this. So again, when the market is trending, we can use divergences, but when the market is ranging, no. Okay, also draw lines on the successive tops and bottoms. So this goes back to the previous videos where we learned how to draw trend lines. Trend lines only work when we draw them properly. If we don't draw them properly, then they hurt us. So if you're not 100% sure on how to draw a trend line, please go back to watching my previous videos so you have that understanding before we trade on divergences, or else trading on divergences won't work for you. Okay, so also number 3, connect the tops and bottoms only. So make sure that that when we make these lines, we're connecting either the opening volume or the closing volume, not the tops or bottoms of the wicks, okay? So yes, we're connecting the previous high with the current high. That's how we do it. And here on the bottom, this is not how we make our lines. Okay, so number 4, we have to watch the price. So we have to study the market carefully to make sure that we are looking at the right kind of trend and we have an accurate study of the price and momentum. So again, this is how we watch the price, okay? Don't focus on the oscillator, just focus on the chart. Look at the chart first. see what type of information you can get from watching the candlestick patterns and also drawing the lines. Then go to the oscillators. Okay, so number 5, the lines must match. Again, anytime we draw lines on any part of the charts, the lines have to be accurate and they have to be in sync with one another. So if you're not drawing the lines accurately, then these tools will not work for you. So again, here these lines were drawn correctly, but these lines were not drawn correctly. So keep that in mind. Also, keep in line, the highs or lows that you identify on the indicator must be the ones that line up vertically with the highs and lows. So again, when we are trading on the relationship of price and momentums, make sure that they do line up and draw vertical lines to make sure that they line up. So in this chart, this is the right way to do it. And number 7, ride the slope. So divergence can only exist when the slope of the line is connecting the indicator, and also when the price and momentum differ. So again, this is the proper way of riding the slopes. Now, number 8, if the ship has sailed, catch the next one. So in this market, we have to be patient, okay? We don't want to be desperate for profits. So you take your time. If you missed an opportunity, then change the charts and see if there's an opportunity on those charts. Or just wait some time and get an idea, or take the time that you're not in the market to learn more about it. And then when you see that opportunity, you'll know exactly what to do. So again, here we have a lower low and here we have a higher low. So this is the proper way of examining this currency pair. So number 9, take a step back. So divergence signals, they tend to be more accurate on the lower time frames. You get less false signals. So this means fewer trades, but if you structure your trade well, then your profit potential can be huge. So when on our trading platforms, you have different time charts. You can look at a 15-minute chart, a 30-minute chart, a 1-hour chart, a 2-hour chart, a 4-hour chart. Divergence trading works the best during the longer time frames rather than the 5-minute, 15-minute, and 30-minute. So it's best to use divergences when we are looking at 2-hour or 4-hour charts, or even longer. So divergence trading is not recommended for day traders. So here's what we've learned so far about divergence trading. So in a regular divergence, now remember, there are 2 types of divergences, regular and hidden. So on a regular divergence, if the lows are going lower on the price, and on the oscillator, the lows are getting higher, that is a bullish signal. So many investors will go long when they see that pattern. Also, if the price charts, if the highs are getting higher and the lows are, and we have lower highs, that's also a signal to go short. And on the hidden divergence, it's the opposite. So if you're looking for a bullish, if you're looking to get in on a bullish trend, then we need higher lows on the price and we need lower lows on the oscillator. And if we're looking to get into a bearish trend, then we need lower highs on the price and higher highs on the oscillator. So, and again, some key points to remember. Use divergence as an indicator, not a signal. And it's not 100% foolproof. Like any tool or any strategy in the Forex market, there is no 100%. And I can't stress that enough. So again, when we get involved in this market, we tend to make mistakes. But we make our mistakes early. The more mistakes we make earlier, the fewer mistakes we make later when we have our money on the line. So again, use the demo accounts. We can practice divergence trading when we use our demo accounts, and then we can see which type of trader we are depending on how we use our divergence strategies. Again, if you're a day trader and you want to open and close during the daytime, maybe the information in this video is not for you. But if you're the type of person that is patient and can keep their positions open for long periods of time, then try divergence trading because it just might work for you. So again, in these videos, we talked about a large number of strategies that we can use when we get involved in the Forex market. Now, I know all of these strategies and all of these methods may be overwhelming for you, and maybe you've probably forgotten half of the information that I've given you in the previous videos, but that's okay. It takes practice in order to get really good at this market. Thank you for watching my videos, and good trading.